Hello everyone, I'm Giorgio and you're watching Avanguardia Investment Media. Today we're joined by a special guest, Michael Howell, Managing Director of Cross Border Capital and author of Capital Wars, The Rise of Global Liquidity. Michael is perhaps the #1 expert in the world regarding capital and liquidity flows, and we are fortunate to have him here today. Michael, thank you for joining us.
Great pleasure, Giorgio.
Thank you. So let's jump into it. In my office, I always keep two pictures printed on paper. The first one is your chart of global liquidity and world wealth. And the second one is a quote by Stanley Druckenmiller that says, "Earnings don't move the overall market. It's the Federal Reserve Board. Focus on the central banks and focus on the movement of liquidity." So my first question is, how important is it for today's investors to understand global liquidity? And in which part of the liquidity cycle do you think we are today?
Okay, well, you're asking a biased person to start with, because for me, global liquidity is all that matters. It's money moves markets, and one of the keys to understanding markets is to really know where we are in the cycle and how liquidity is moving in or whether it's moving out of markets. And the main conduits, certainly today, of that money flow are the Federal Reserve in the US, and also one has to keep an eye on the Bank of China, the People's Bank of China in Beijing. I mean, those are the important drivers of the system. I mean, sadly, the Bank of England, the Bank of Japan, and the European Central Bank have been long eclipsed. They're really in the sort of second row now. It's really the People's Bank of China and the Federal Reserve that are really driving the system. And I think if you take that a stage further, you'd say that the Federal Reserve really dominates the financial markets, whereas the People's Bank of China, because of its impact on the Chinese economy and the size of the Chinese economy relative to the world, the People's Bank of China has a much bigger effect on real economies.
Okay, so probably regarding commodity prices and all the real estate market that you have there. And yeah, talking a little bit about China, I didn't prepare this question, but now that we are talking about, what's your view right now on China and at the same time the US? Because the US is on a really aggressive tightening cycles. We just saw another 75 basis point hike by the Federal Reserve. On the other side, China is stimulating the economy and the Chinese yuan is devaluing against the dollar. So what's the relationship and how do you see things going out from here?
Okay, well, the first thing to say is that China has been tightening policy through much of the last 18 months. They, unlike Western central banks, did not ease aggressively during the COVID crisis. They've actually maintained a pretty tight policy, which is actually one of the reasons the Chinese economy is doing badly at the moment. Part of the reason for that is that China has had a policy pretty much since 2016 of trying to manage or stabilize the Chinese yuan currency. And that is part of their long-term goal to ultimately displace the US dollar. Now, what the Chinese are trying to do here is to create a stable standard of value from which other governments or other countries can actually fix their currencies to. So in other words, they're trying to recreate the role of the US dollar, let's say, but in the Asian region. Now, this is their long-term goal. It's not going to happen overnight, but one of the prerequisites to that is to have a stable yuan currency. And that's what they've been trying to do over the last 5 years. Now, clearly, as we speak, they're failing because the yuan is testing 7.2 against the dollar, whereas through much of this year, it's been around about the 6.4, 6.5 level, but it's recently weakened. And I think that you've got to come back and look at what's going on in markets generally to understand that process. And generally, the background is that the US policy in 2022 has been to get the Federal Reserve balance sheet down and the US dollar up. And as the dollar goes up, it basically disturbs Forex markets worldwide. So what you've seen is not only a weaker Chinese yuan, you've also seen a much weaker Japanese yen, much weaker Korean won. You've seen the euro tumble. You've seen sterling as we speak tumbling. Currency markets around the world are being disturbed by the strong US dollar. Now, the Chinese have tried to fight that, and consequently, they've been maintaining through this year a tight policy, an unusually tight policy, particularly in the face of this COVID crisis that they're still going through. However, the fact that they've now allowed the yuan to devalue through the psychological 7 barrier probably means that they're now accepting that, at least in the short term, the yuan will be weak. That may give them a degree of freedom in boosting monetary policy. So, in other words, what we should be looking forward to is some easing in Chinese monetary conditions over the next 6 to 12 months. That may well coincide with the October People's Congress, the 20th People's Congress, which is when Xi Jinping will be re-elected, and there may well be an associated policy move with that re-election. That's something to expect. Now, China is therefore a market to watch closely, because it was the first stock market to go into a bear phase about a year before Wall Street, and it may well be the first one to come out. And at least now the People's Bank of China has the flexibility to ease policy. So we can park that thought about China. China's one to watch, and it may be the first market to bottom. If we come on to the US, the Federal Reserve is very clearly tightening monetary conditions. I think you've only got to look at that in interest rate terms, that 6 months ago we were thinking of US interest rates of being 25 basis points. Now they're likely to exceed 4% by the end of this year. So that's a dramatic tightening. The Federal Reserve is very clearly front loading the tightening. They're squeezing the economy hard to get rid of inflation. On top of the rate rises, and more significantly from my perspective, they're also shrinking the balance sheet and curtailing liquidity conditions. And that is a significant squeeze, probably an even bigger squeeze than you can see in terms of interest rates. The best heads up to that is to look at what's happening to one part of the bond market, which is the yield curve, particularly the yield curve at longer duration spreads. So looking at things like the 10-year minus 5-year bond spread, which is a very good heads up to something that's called a term premia. And the term premia, although a wonkish concept, are the main way you value bonds. As that spread between the 10-year and the 5-year falls, narrows, and actually goes negative, so the 10-year bond is yielding less than the 5-year bond, that negative spread is telling you that term premia are themselves very negative. And that is a real warning sign, both for policymakers and for investors. Negative term premia in markets warn us that risk aversion is very, very high, and the bond markets are getting there. One of the paradoxes that's hard to understand for many people in financial markets is that you can still see bond yields going up, right, even though risk aversion is actually on the rise significantly. And that's a technical feature because the Fed is raising policy rates so fast. But believe me, the really worrying dimension is this negative term premia, and it's a forewarning of deeper financial problems out there.
Yes, and actually, one of the questions I was going to ask you was about term premia, because I followed you in a recent Twitter space that you did with George Noble, and you tweeted the elephant in the room is the all-time low in term premia printed in the bond markets. Icarus has already fallen. It points to a 20% fall in SPX earnings in 2023. So I guess for those who don't know of the audience, could you explain what term premia is? I know like you already explained it a little bit, but could you expand on what term premia is and why it's so important?
Yeah, I'll have a go, but it's a wonkish concept. Basically, a bond has two moving parts. The first part of the bond is interest rate or policy interest rate expectations over the life of the bond. So in other words, if you're looking at a 10-year bond, what the investor is estimating is what policy rates will be, what Fed funds rate will be over the entire life of the bond. Okay, so if it's a 10-year bond, what is Fed funds going to be in theory over a 10-year period? Okay, once you've taken that interest rate expectation into account, then there is a residual between that estimate and what the market is currently pricing. So in other words, if you average Fed funds rate over 10 years, and the answer is it comes out to, let's say, 5 percentage points on average, and the US 10-year bond is yielding currently 3.7%, that difference, 5 minus 3.7, gives you a negative 1.3, and that negative 1.3 is the term premia. Now that term premia is going to be influenced by supply and demand factors beyond anything else. Okay, so in other words, if you've got a big negative term premium as we have now, it's telling us that there is excess demand for duration at that 10-year tenor. And that is important because the 10-year tenor in the bond markets is really the benchmark bond that a lot of institutions will move into as a safe haven. It's often regarded in that way. It's also used, that bond is used fundamentally within the financial system for collateral as well, for collateral purposes. Now, if you've got negative term premia, it's telling you effectively one of three things. It's either saying that there's big demand for bonds as a safe asset because investors believe there is a big recession coming, right? That could be correct, right? But it gives the bond markets a lot of prescience, which may not be deserved. The second reason is that there's a general shortage of collateral in the system. And collateral is vitally important, particularly post the global financial crisis in 2008, because lending, in other words, credit, is advanced against collateral in many loan contracts. Okay, so you have to post collateral before you can take a loan. Now, I'm talking here not in the retail space, but in the wholesale space. So in the wholesale markets, they're very much collateral based. So if you want to borrow, you've got to post collateral, often in the form of a bund or a US Treasury bond. If there's a shortage of those, then that will be reflected in the price and you'll get much lower yields and hence negative term premium. Third reason is there's a liquidity shortage, and that liquidity shortage is creating a heightened demand for bonds because investors are fearing systemic risk. One of those three factors are driving, or all of them are driving term premium down at the moment. Any one of those three things ought to be of concern to policymakers and ought to be of big concern for investors, particularly equity investors, because none of those are good news. And that's hence the warning that we're raising. And we're saying, we're disposing the question, in 60 years of data, term premia in the US on the US 10-year bond have never been lower than they are now. They're all-time lows. And that's got to tell us that something odd is happening. And it's not a good message.
Right. And probably next year we're going to have the first signs of whether these bond investors are right about the coming recession or not. And talking about safe assets, in your book you talk about safe assets, what safe assets are and how are important inside the system. What do you think are the safe assets right now, and do you think there is a shortage of them and in the system or not?
Yeah, there's unquestionably a shortage. Let me say that up front. In terms of what is a safe asset, a safe asset is really deemed to be an asset which is, let's say, represents pristine collateral. It's something that you can use to borrow against. It's very, very liquid. Everyone will accept it, and you can sell it easily without any significant losses of price. So you know if you're selling a US Treasury bond, the market is deep enough and the price is guaranteed for you basically to not lose very much money. And that's really the key point. So it's something you can be absolutely assured of in terms of its value. Now, there are very few of those instruments around. Generally, I mean, as a fact, that's why they're valued. The things that you could really point to are US Treasuries. That is the main source of collateral. Secondly, German bunds. Thirdly, possibly, and I say this with hesitation now, Japanese JGBs, Japanese government bonds, or UK gilts, but the latter two are being eclipsed by currency weakness. The bund is good collateral, but at the end of the day, there are hardly any bunds in circulation. The ECB, through its QE operations, have hoovered up most of the bonds most of the 10-year bunds in the private sector, of which there's only about 10% free float left. So there's a shortage. Now, what you've got to add in as well is two other things. One is that the regulations that regulators put in after the global financial crisis, the so-called Basel III and Solvency II arrangements, are basically increasing the need for financial institutions to hold collateral, good quality collateral, like US Treasuries or bunds. And the other factor is that the austerity policies of governments since the global financial crisis has actually reduced the supply of these bonds coming out of governments, out of public sectors. So you can see there's probably a structural shortage. Now you may well, and this is what happened ahead of 2008. You may well then go lower in quality in the capital stack and start to get private sector corporate bonds like AAA or investment grade bonds to include in your collateral pool. The trouble is that those investment grade bonds can change in quality, and they can deteriorate. And what we saw very clearly with mortgage-backed securities ahead of the 2008 crisis was that mortgage-backed securities were pristine collateral at one time. They were AAA, but they soon went to junk quality because the underlying value or the underlying asset that backed the bond just deteriorated. And that's the risk of a private sector instrument. So it's really government bonds that are the key thing.
And just a last question about safe assets. Regarding safe assets, would you say that gold could be referred to as a safe asset, or that wouldn't be?
It's a very tricky question, and I'll give you this answer. Gold is not an inflation hedge. Okay, it's never been an inflation hedge, although people ascribe it to be an inflation hedge. And you can see that right now. Why is the gold price not going up when inflation is very high in most economies worldwide? And the reason is that gold is not an inflation hedge, it's a monetary inflation hedge. So it's a hedge against the largesse of central banks, right? So if central banks print money, the gold price goes up. If central banks shrink their balance sheets, the gold price goes down. So what are central banks doing now? They're shrinking their balance sheets, and what's happening to gold is going down. So it's a safe asset in terms of hedging central bank profligacy. So if central banks, or when central banks return to QE, buy gold, equally buy cryptocurrencies, because they are also a very good monetary hedge. They may be a more levered monetary hedge than gold right now. But both of those two assets, cryptocurrency and gold, are classic monetary hedges, and they're going down if central banks are destroying money or destroying liquidity, which is what they're doing now.
Yes, right. And this is exactly what a lot of gold bugs, let's call it that way, are very frustrated right now, because they're like, oh, inflation, it's a decades high, and anyway, gold is going down. So that's because liquidity is getting out of the system. And talking about liquidity and looking at the current liquidity cycle, at what stage of the current liquidity cycle do you think we are, and how long do you think will the central banks be able to continue on this path of draining liquidity until something breaks and they will be forced to restart QE and go back at it again?
Okay, well, I think the answer is that we look at the liquidity cycle as having 4 phases. Okay, so we think of the low point and the initial pickup in the cycle as being a rebound. Then we basically have the next phase where the liquidity cycle is above average but still rising. So think of a sine wave in this form. That is what we call a calm phase. Then we have a third phase when the liquidity cycle is above average but falling. That's a speculative phase. And then the final phase is turbulence, where liquidity is below average and falling. Now, those are states of liquidity, and they precede the equivalent states in financial markets by about 12 months or so. Currently, we're in the turbulence phase for liquidity. Liquidity has plunged in the last 12 months. We've been warning of an imminent or a coming financial correction since, well, probably September, October of last year. We said it's likely to come in 2022. So it's panning out. We're at a point now where the liquidity cycle is very much near its bottom. On a range of 0 to 100, which is how we measure our index, the current reading is 17. It rarely gets much lower than that. And by the way, the central bank component is about 12 of that, 12, an index reading of 12. So it's very, very low. It's unusual for it to go much lower. So what we've got to say is, to draw an analogy, if you're lying on your back, things are looking up, right? So it can't get much lower. But even if liquidity starts to rise, it will be some time before it affects markets. And I would imagine that on on a 6-month view, the liquidity cycle would definitively bottom and be picking up. But that won't be enough to save markets in the short term. And I think you've got to expect still about at least 3 months or more of pain. I mean, we may be going through a crash as we speak, but things are getting very ugly because bond markets are selling off worldwide. The dollar is surging, and the fact that term premium are more and more negative is telling you there is heightened demand for safe assets, and this is clearly a problem. Equity markets are going to have to wake up, and one of the implications, which you noted earlier on, is that the level of term premium, the very low level of term premium in markets, is indicating that corporate earnings are going to crash in 2023. So in terms of the timeline, a bear market, which we're well and truly in, has 2 down legs. The first down leg, a 25% drop, which we've had. Then you get a rally on average of about 10% over 2 or 3 months. That's what we had in the summer months. And then you get another leg down of a further 15 to 20%, which is really on the basis that earnings get smashed. And that's the phase we're entering now, in our view.
And do you think we, based on the current system and the liquidity that it's in the system, do you think we could see something like 2008, where we see a liquidity crisis and credit markets just go wild and things really sell off, not really in an orderly way? Do you think there is a risk on that? Yeah, exactly.
I think the odds are meaningful. I'm not going to say it's 100%, but it's probably more than 50%. And I think the fact is that there are areas of the financial markets which look very vulnerable. Now, that could be the corporate bond market. It could be the Forex markets. I mean, the Forex markets are under a lot of tension at the moment. It could equally be private equity. I don't believe it's the banking system this time. I think the banking system is actually quite robust, given the reforms that were put in after the 2008 crisis. But I think there are fringe areas of finance that are always vulnerable to this. And one's got to be open-minded, because it's very difficult to actually pinpoint exactly what the area of distress will be this time. It tends to vary. But I think with liquidity at these levels, there is tension in the system somewhere.
So based on these assumptions and these facts, what's your general investing approach at the moment? What do you think? Are equities completely to be avoided? I guess the answer is yes. And is cash no longer trash, as many were saying last year? We saw Ray Dalio and many others completely calling cash just trash, even though if you held dollars this year, you were doing pretty well, actually. And what's your view on bonds, both on for investors to... What's your view on bonds for investors right now? Is it too early or not, given that the Fed is still raising interest rates?
Right. I think I think generally, if we move through the asset classes, I think the dollar still is the best currency for now. Having said that, I think if the authorities are concerned about financial stability, they will be trying to engineer an inflection in the dollar. But until they do, the dollar looks good. The second thing is that if you take bond markets, the front end of the yield curve, particularly in the US, so in other words, the front end, 1-2 year yields look very enticing. You're getting well over 4% return on those. That's got to be a pretty good carry in this market. Further down the term structure, I would be, interested, but not. I don't feel it's a compelling buy yet, but it may well be. I just think that the front end is a lot safer right now, and on a 12-month view, I think you could be buying longer dated bonds. Yep, that would make sense because there's a recession coming. In the corporate space, I would tread carefully, but the yield spreads that we're getting at the moment in many corporate issues would tell me that we're probably close to break-even levels on a 12-month view. Okay. Now, that's not to say you won't lose money over 6 months, but if you held a bond over that window, you'd probably break even. So there's not a great incentive, but it's kind of watching. Equities, I'd be very skeptical of. I think there may be another 15-20% down in equities. So I'd still steer well clear. At the moment, we run investment funds as well as doing research. And our investment division runs a UCITS fund, and that UCITS fund basically invests in futures, equity futures. So it's 90% cash anyway throughout its life. I mean, that's how it operates, which means that it's getting a 4% return on that 90% cash anyway. So it's a great head start. And then in terms of futures, we're basically a little bit net short markets right now. We're probably about 30-40% short. We will move net long, and probably more aggressively net long, at some stage over the next 6 to 9 months. And the point about that is that central banks will be forced to come back in to do QE again. Now, as a hint to that, there are 2 big hints, or 3 big hints. One, as I mentioned, China is likely to be easing at some stage, and China matters a lot for the world economy. Secondly, at their 75 basis point rate hike meeting, the ECB slipped in an incentive for banks to hold the TLTRO loans for longer. So the ECB balance sheet is not going to be shrinking anything like as rapidly as was first slated. And that may mean a weaker euro, which could be good for corporate earnings in Europe. But it does, it does mean in the near term you've got a headwind for European markets, but ultimately they'll come good. And then in the Federal Reserve's case, Chairman Powell last week at the Cato Institute actually dropped in a sentence which said, "We will use QE again if it's necessary." So that suggests to me that if there's a financial turmoil, they'll come back. Now, we think they'll come back within the next 6 months. They'll have to, because things will look so bad. And as that liquidity comes in, it will begin to work its magic on markets. After a bear market, equity markets almost go upwards in straight lines. And the average return for the S&P over the next 2 years from a bear market low is plus 40%. And that's what we want. We want to get some of that.
Yeah, for sure. That's really fast moves, almost like bear market rallies that can rip your head off. But that's the beginning of a new bull market. Now, talking
Correct.
about the euro, you mentioned, now we have the euro that's at decades lows against the dollar. This morning it's below 0.98. And what do you think? Do you think it's cheap right now, or do you think it's still expensive compared to the dollar, based on the current situation?
I think in terms of financial assets, I never think about being cheap or expensive. I think of where they're going, the direction they're heading. It's about flows and about liquidity flows that are really driving them. Now, the question is, what's going to happen to the euro? And I think the euro has to go lower, right? Probably a lot lower. I think I would tend to think it goes to something like 85 against the dollar ultimately. Now, that may not be overnight, but I think we're heading in that direction. And the reason fundamentally is that this is only let's say a British person or American can say this, is that the structure of the euro is sort of fatally flawed. And the reason basically is that there is no safe asset in the euro system. Okay, what's the safe asset? The safe asset is a national asset. It's called the German Bund, right? And that means the whole system can never work properly. What they've got to create is a euro-based, euro-denominated safe asset, and that doesn't exist, right? What I mean is a trans-euro safe asset that people can buy, and that doesn't exist. Now, there have been attempts to create that, but we know that that will never happen in reality. So every time there's a crisis in the eurozone, investors buy bunds, right? And so spreads widen, and to keep those spreads in line, the ECB has promised to basically print money, or to use a QT process, whatever acronym they call it. It's going back to QE again, and that QE will basically cause the euro to weaken, particularly if the Federal Reserve is engaged in a QT process. So that's really the backdrop. And what you have in the euro area is a problem that what the euro needs to survive is basically a pan-European fiscal policy. I mean, that's what it's missing. It's never going to get that. So you're always going to go through crises. And rather than the euro breaking up, which is an unlikely scenario, what you'll get is the level of the euro will change, and so it will have to go down. And you can think of it, if you even go to, straightforward economic parlance and say, well, look, we just had this whopping great negative shock to the euro area, be it energy or whatever it may be. That means that the real exchange rate's got to drop to re-equilibrate the system. And basically, that's what we're sort of moving towards.
Right. And last question about currencies. We have just seen the Japanese yen devalue and go above 145 against the dollar, and then we've seen the Bank of Japan doing an intervention in the forex market. Do you think this is something we're going to see eventually more and more, maybe even in the Eurozone? Do you think they will be trying to save the euro doing interventions? And do you think these interventions have lasting effects, or they are only temporary?
Well, I mean, I think the point is that, if you look at the context, look at what, if you come back to the yen and look at the situation in the yen, which is probably the best starting point, the yen has devalued dramatically, we know, this year. Okay, between March and May of 2022, the yen devalued an 82% annualized rate. In all my years in markets, I've never seen markets do that to a currency. Only governments do that, right? I believe, and this may be conspiracy theory, that there was a deliberate attempt to push the yen lower. Now, was that on Japan's behalf, or was it on a joint Japanese-US behalf? The very fact that the US Treasury said nothing about the devaluation of the yen through that period, America's second biggest trading partner sees its currency collapse. Why didn't they say that was unfair competition? Because they said that about the Vietnamese dong 18 months earlier, of a much lesser fall in the dong. So they were complicit. And that may have been an attempt to generally get the dollar up, okay, and put pressure on China. That may well be the explanation. Only now are the Japanese intervening. Will they be able to hold that? Sure, if they change policy, okay, they'll do that. Ultimately, the Japanese have to raise interest rates and tighten monetary conditions in Japan. We're moving in that direction. That will happen. As regards the euro area, can they stop the euro going to 85 against the dollar, 85 cents against the dollar? Well, yeah, if they tighten monetary policy sufficiently, yeah. But are they going to do that and create a massive recession in Europe and watch spreads just blow out? And we know that the situation in many economies, Italy being one of those, is that if spreads start to widen significantly, the interest burden on the government or on the public sector would just be just too much. So it can't happen. So, you've got a classic case now where, if George Soros was still, investing, he probably is. I mean, he should be putting a short on the euro against the US dollar. It's a natural thing to do because the policymakers have got their hands tied.
Right. And talking about the dollar and the consequences of a higher dollar, in the 1980s, we saw the countries uniting and having the Plaza Accord. Do you think there will be a maximum pain point? And if that is something that you think will be, how far is this maximum pain point of a higher dollar? And do you think we could see another Plaza Accord?
I think the answer could be yes. I think whether they actually go to whether they have anything as formal as a Plaza Accord, I doubt, right? But there may well be agreement at a G20 meeting or G10 meeting or whatever to try and stabilize currencies and stop the dollar going up. Now, if you think of it in geopolitical terms, given what Russia is doing to Ukraine, and given the vulnerability of Europe to whatever the Russians are doing, okay, it would not be in America's interest to see the euro collapse and a big recession in Europe. So it may well be that we're getting close to the pain threshold where the Americans actually think we've got to start arresting this situation now and trying to pull the dollar back. Currencies are geopolitical instruments. Okay, America has weaponized the dollar but it's a big weapon, and probably they're realizing that it's too big now. In other words, it's too powerful. They've got to try and ease off a little bit here.
Michael, thank you so much. This conversation has been incredible. I'm sure people will love it. And where should people go to learn more about you and the work you do at Cross Border Capital?
Well, you can look at our website, which is crossbordercapital.com, or you can look at Twitter, where the handle is crossbordercap.
Perfect. Thank you so much, Michael.
Pleasure. Thanks so much, Giorgio.